Hello everybody, my name's Drew Demon and I'm the Devil's Stockbroker. This is going to be a really short update, and I really do mean short, but I wanted to point this out. What we're going through right now is somewhat unprecedented. Um, Currently on the chart in front of you, there is the S&P 500 ETF SPY. On the upper chart is our present day, and on the previous chart is the 2008 Global Financial Crisis chart. So there are some consistent patterns in both of these charts that really point to a huge crash coming our way very soon. So I'm going to try and help everybody navigate this as accurately as I possibly can, but please understand that the following is absolutely not financial advice, and there's no way that I can predict this with any degree of accuracy. I don't have crystal balls. All I have are lines on a chart. But I do have some technicals and some history to draw from that tell us that we're in for some serious hurt. So, similarities between our previous chart. The last year that we have been trading since December when we peaked is pretty consistent with the high from the 2007 peak, just before the crash really began. Seasonality played a significant factor in the S&P in both of these charts. You'll find that if you compare a seasonality chart with what happened in 2007 through 2008, it matches up very closely with our own chart, and seasonality dictated quite a lot of that activity as well. The main difference is that we are slightly askew in that the peak for the 2008 global financial crisis came at the height of a housing market that was red hot and suddenly rapidly cooling off because a wave of foreclosures and massive loan defaults in the housing market. We're going through our own financial cooling period in the housing market, but it's not leading the entire market to the downside. We haven't even had that crash yet. So while the S&P back in 2008 was ripping and roaring on its own accord, it wasn't catalyzed by massive quantitative easing like ours is, and it wasn't catalyzed by massive overpricing of commodities. The housing market alone is what caused the 2008 crash because of things like credit default swaps and treasuries collateral going bust. So what about our current market, and why is it moving so closely with the SPY? I mean, we have a top here and two-touch bottom, a top here and a two-touch bottom that started a megaphone pattern, another touch to the top and then another touch to the downside, a third touch on the top, just like here, and then we had a bottom halfway down in the megaphone, just like this. Now the difference that I see here is that we're only slightly at a lower low, while the S&P created a significantly lower low that was almost a 5 to 6% difference, whereas our low is less than 1.5%. What this tells us is that if this chart correlates, and it does, it correlates within a 90th percentile, meaning that 90% of our chart correlates with the moves in the S&P 2008 chart. So there's very clear correlation. It's significant. Then it dictates that we still have a slight move to the downside, but that we will have a rally coming up ahead of us. Seasonally, the rally that 2008 saw was a rally from July to August. That actually matches up with the dates for the rally that we had here. Although our rally was very significant, it still was only a 20% rally from peak to trough, which is consistent with bear market rallies in history, which you'll find the 2008 global financial crisis big rally was a 13-14% rally. We're due for a small one, on par with 2008, right before the great fall that occurred that October. What this will look like for us is we're likely going to put in a new low, somewhere I'm estimating around 350. And it's probably going to happen before we go into mid-October. But starting mid-October, this rally is likely going to take us for at least a 6 to 12% ride back to the upside, where we will fail to break previous highs. This zone is what will act as resistance for the S&P once we hit a new low. Wherever this new low is going to be the breaking point for the S&P 500 going forward. So wherever we bottom here is going to be the breaking point. So expect a rally of some kind. For me, I'm probably going to just try to stay out of its way, avoid shorting anything, and just try to catch rallies, maybe in the energy or the commodities sectors, trying to grab gains wherever I can. But once we hit this top, it's going to come down, and it's going to come down fast. The 2008 crash saw a less than 1 month retracement of all of its previously regained momentum that took half the time. It took half the time to fall as it did for the rally to take place. This is consistent with a seasonal holiday rally that we tend to experience in the fall leading up into Thanksgiving and Christmas. So sometime after October ends, at least in the first week of November, is when we're going to start seeing a big rally. We'll probably have plenty of volatility, pops and declines in between now and then, but I don't want anybody to get rug pulled because we've been seeing this big sell-off and we've been selling off for quite a while. We'll probably get a little bit more out of it, but don't over-leverage yourselves playing this massively to the downside. Give yourself at least some breathing room and step away from the charts. Right now, contrarian indicators like the put-call ratio are showing extreme fear in the market, and just as people get super fearful is right at the moment when the market turns back in the other direction, it rips all of the gains that everybody had gotten on the way down back out of their hands as they take it back to the upside. And then at that moment, people feel jaded, cheated, and they step away and they stop looking at things rationally. So keep a close eye on this. Again, I do expect some downside for the near term, but in the next month, we will probably expect to start a rally going into November and December. And that would put us on track for a move similar to this, where once we retrace and go back into a bearish season starting in January through May, that is most likely where we will see big pain. And I think that the housing market is going to end up leading it. Keep in mind that the housing market will cool off naturally and listings will come off the market starting in sometime around the holidays, just because that's not a good season for the housing market. And what this will likely translate to in the stock market is, the housing market is returning to a seller's market. The sellers are taking their houses off of their listings, and buyers will feel urgency. But what nobody else is taking into account is the rapid increase in mortgage rates, and that will continue. That's all I've got for now. I'll do a more complete analysis next week and give everybody a good lead on what to expect in the market coming up soon. Thank you guys so much for watching. I'll look forward to seeing you on Monday at the bell. But until then, have a hell of a weekend.